Welcome to all, and thank you very much for joining today. Good morning, good afternoon, depending on where you are. We have participants across almost all LATAM today, from Brazil, Colombia, Argentina, Uruguay, Mexico, Peru, Paraguay, amongst others, and from very different subsectors of the financial industry, pension funds, brokers, advisors, even government officials. So thank you very much for joining us. Thank you for your time. I'm Barbara Mainzer from CFA Society Uruguay, and it is my great pleasure to welcome you to today's webinar on emerging market sovereign debt, opportunities and outlook for 2021, co-organized with Colchester and CFA Society Uruguay. And now, with no further comments, I will pass it on to Analia Giacchino, who is Colchester's Regional Product Specialist. Analia, it's all yours.
Well, thank you, Barbara. Thank you for the introduction. And as usual, thank you for the continuous support that the CFA Society in Uruguay is providing Colchester. We're really delighted today to be hosting the first event of the year. Many things have changed since we last spoke to you. Last November, if you recall, we had this forum on China. We have a new president in the US. We have yields, particularly in the US, spiking, and the vaccination being rolled out in many countries. Yet some of the things stay the same, particularly here in LATAM. We're still working from home, as you can all see, and the pandemic for us is far from over. So inflation has also become a topical issue amongst investors, and ESG is gaining traction, fortunately, also in our continent. However, today we decided to go back to the basics and focus on the very essentials, and which is really to evaluate our own sovereign debt in the middle of the many challenges that we have in 2021. So it is my pleasure to introduce my colleagues from the London investment team, Mark Capstick and Cian O'Brien. Many of you will know Mark from the previous CFA seminar, which I mentioned on China, and the numerous meetings he has patiently done with me across the region. He has an ample experience on EM sovereign debt, and he assisted in the early 2000s in setting up the first Asian local bond fund. Now, he will be joined today by Cian O'Brien. He's a senior investment officer at Colchester. He's managing both developed and emerging market debt. And just as a matter of a brief background, Cian worked for the Central Bank of Ireland until 2011, when he joined State Street as a senior portfolio manager on the fixed income team. Cian is a CFA charter holder, and he will join us today from his home, which is in Dublin. After the presentation, and we've tried to do it a bit differently this time, we will open the floor for questions and answers. So we will give you a space. We encourage you to send questions through the chat. We want it to be as interactive as possible. And both Mark and Cian will be answering and addressing those.
No sé cómo activar el...
I leave the floor.
If you can please put your microphones on mute. Por favor, muteen los micrófonos.
Yeah, if you could put it on mute, we would appreciate that. Si los ponen en mute. So as I said, I leave the floor to my colleagues, and I hope you enjoy our presentation. And as many questions as you can throughout the course of the presentation. Yeah.
Sophie, ¿puedes mutear a todo el mundo y desmutear solo los oradores? If you...
Okay, thanks Analia for the introduction. Hopefully everybody can hear me. And I'm just going to move through some of these slides to the introduction. So, as Analia has said, Mark and I work on the investment team at Colchester Global Investors. And today we're going to give you really a high-level introduction, firstly, to emerging market debt, have a look at how it might fit into a diversified portfolio, its risk and return characteristics, diversification benefits, etc. And then we're going to take a look at how we analyze and value the local and hard currency subsectors, if you like, of the emerging market debt universe. Because as we will repeat a few times through this presentation, we do think it's very important to differentiate between local and hard currency, and you'll see that we take a slightly different approach to analyzing valuations in both, and then hopefully we'll wrap up with a few conclusions that might be relevant for investors and open things up to a Q&A session. So firstly, and by way of historical background, if you like, to the emerging market asset class, and I'm sure this is information that most of you will be very familiar with. If we start with what do we mean by an emerging market? Well, it isn't something that's precisely defined, but clearly we all understand what we mean by an emerging market. Typically an economy with a lower level of per capita income compared to advanced economies, and generally economies with weaker or less established political and economic institutions. And clearly the term emerging market implies some kind of transition or movement toward a higher level of development, although this is clearly not necessarily always the case. We at Colchester are bond investors, so we're going to focus today on emerging market debt, and emerging market debt can be subdivided, if you like, into three distinct asset classes: foreign currency denominated sovereign bonds, local currency denominated sovereign bonds, and corporate bonds. And today we're really going to focus on the first two of those. In other words, we're going to look at sovereign bonds both in domestic and hard currency. And again, a little bit of history that everybody is no doubt aware of. The emerging market sovereign bond markets date back to the late 1980s and early 1990s, and the Brady Plan of that time to address the debt crisis of the 1980s. And the bond market was initially a largely US denominated one. And it was in the early 1990s, 1992 in fact, when what is now the standard index for hard currency debt was established, and that's the JP Morgan MB, or the Emerging Market Bond Index, launched initially with 14 countries, but today, given the growth in the asset class and the growth in the number of issuers, there are actually issuers from 73 different countries in that index today. And then, as the 1990s progressed, clearly we moved into the Asian financial crisis, which highlighted the vulnerability of the fixed exchange rate regime and foreign currency borrowings. And many emerging markets began to look to build resilience really through building up foreign exchange reserves and developing local currency bond markets. And in 2005, what's now the standard benchmark for local currency EM sovereign debt was launched, and that's the JP Morgan GPI EM, an index which today contains 19 countries. So the history is relevant here because over time, those emerging markets with stronger balance sheets essentially and stronger institutions have shifted their funding model towards local currency. The local currency bond market has grown larger than the hard currency universe. And in fact, even by 2007, some 2/3 of trading on the secondary market was in local currency rather than hard currency. So where are we today in terms of those two universes? Well, as I mentioned, the local currency universe has grown and is today materially larger than the hard currency universe. The benchmark, the standard JP Morgan local currency benchmark, market cap is around $2.1 trillion, but this actually doesn't include a number of large issuers of local currency sovereign debt, such as Egypt and India, because they're not in the benchmark, at least not yet. The hard currency universe, as I mentioned, somewhat smaller at $1.3 trillion US. So you have here some index characteristics for each: yield, coupon, duration, etc. So it's worth just pointing out a couple of these and some of the characteristics that hopefully will come to the fore through this presentation. The yield to maturity is slightly higher, as you can see, on the hard currency index. That's the JP Morgan MB at just over 5% compared to 4.7 for the local currency index. But the hard currency index has a materially longer duration, as you can see, so a higher sensitivity to yields or interest rates, and it has a lower average credit rating. And that credit rating point is something we'll come back to in a moment. But essentially, it demonstrates that over time, as I've said, over time, those countries that have shifted funding towards local currency have reduced currency mismatches, reduced external vulnerabilities. They now tend to be the stronger credits or the stronger balance sheets within the emerging market space. So I might just move on to this slide, as we've mentioned, credit ratings, because whilst many investors will look at EM debt, EM sovereign debt at least, local and hard currency as two sides, if you like, of the same coin, it's important to understand the different risk profile in each. And just a simple demonstration of that is the credit rating. So here you've got in blue the rating profile of the local currency index, and in gray the hard currency index. So you can see quite clearly, hopefully, that the local currency index is typically of higher credit quality. So around 80% of that index is rated investment grade, whereas the hard currency index is close to 50-50 in terms of market cap between investment grade and sub-investment grade. And you can see out to the right, there is a tail of quite lowly rated credits within that hard currency universe. Issuers like Zambia, Lebanon, or Sri Lanka that are essentially in some form of financial distress at present and are rated single C or maybe triple C, whereas the lowest rated issuers in the local currency universe are in that double B bracket. So the likes of South Africa, Brazil, and Turkey, for example. So just moving back then to take a look at the historical return and volatility characteristics of these two asset classes and to compare them against a whole range of other asset classes, but mostly fixed income, global equities at the very top. So we can see here that both classes of emerging market sovereign debt have outperformed developed market sovereign debt and investment grade corporate debt. Over the long term, hard currency EM debt has actually outperformed local. So you can see hard currency EM debt is third from the top with an annualized 8.2% or so return compared to 6.7% annualized for the local currency benchmark. But again, besides the obvious that this is looking at the past and the past isn't necessarily representative of the future, we've also seen that the hard currency universe is on average more lowly rated, does have a higher, longer duration, so that higher return historically is partly a compensation for the higher risk. And it's also worth mentioning here that emerging market currencies, on average, have now been on something of a weakening or depreciating trend in terms of their nominal exchange rates for the past 10 years or so. And we'll point out later on in the presentation that, in our opinion at least, emerging market currencies are now fundamentally undervalued in real terms, and that's supporting potentially positive contributions to returns from FX going forward. But in terms of looking backward at historical returns, there has been that period of currency underperformance or depreciation. If we look at local currency EM debt in currency hedged terms, I think that's something interesting, worth pointing out, because investors don't often consider hedging local currency EM debt. Clearly, given the higher interest rate profile, it's generally considered to be suboptimal to hedge such an exposure. But if you look back over the past 18 years or so, local currency EM debt in dollar hedged terms has produced quite an attractive risk return ratio. So it's fourth from the bottom. You can see an annualized return, dollar hedged of 4.8% and an annualized volatility of 4.3. In other words, the returns are less when you hedge the currency exposure back to the dollar. The returns are less, but the volatility drops by significantly more than the decline in return. So your volatility actually drops from more like 12% down to 4%. So quite, even though a lower return, quite an attractive ratio of annualized return to volatility from local currency hedged into dollars. So now at this stage, we've covered the history, we've covered the historical return and volatility profile of each asset class. I just want to take a look at the broad macro backdrop today and consider what that means for the fundamentals, if you like, of balance sheets, of sovereign balance sheets in the emerging market space. And we're just looking here at high-level aggregate measures. So we don't have the time to drill into every individual country, but I think what's clear from this chart is that the aggregate balance sheet, if you like, across the developed, or across the emerging sovereign universe, I should say, is in relatively robust condition. So if you go back to 2019, on average, the debt to GDP ratio for the emerging market cohort, if you like, was around 50% compared to over 100% for developed markets. And the level of interest cost as a percentage of GDP was broadly similar. In other words, the actual servicing cost of that government debt was broadly similar across developed and emerging markets. So clearly, despite the lower level of debt in EM, higher levels of interest rates typically paid. We go through 2020 and clearly public sector balance sheets have been put under huge strain by the cost of the COVID pandemic, both the decline in activity and tax revenues, and then the cost of trying to support households, trying to support businesses, and trying to provide, obviously, the health services in a pandemic has led to a huge increase in fiscal deficits and a step up in the level of debt to GDP. But again, when we look at that increase in the level of public sector debt, the increase is more modest on average for emerging markets compared to developed markets. And those interest costs, or that cost of servicing the public debt, has gone up a little bit. The red line is the interest cost for emerging economies, but it remains, by historical standards, it remains manageable and affordable. And this is obviously an average or an aggregate measure. There are individual markets, certainly, economies, as we've mentioned earlier, like Lebanon or Zambia, for example, where there are clearly balance sheet issues. But on average, we believe that the emerging market universe is in a relatively robust position to withstand what clearly is a substantial shock. And that's partly because policy, macroeconomic policy making, macroeconomic institutions in many of the major emerging markets have structurally improved over the past decade or two. And we've seen the evidence of that improvement, really, we would say, in 2020, where central banks were able to implement counter-cyclical monetary policy in a severe global crisis. So you saw central banks from obviously Mexico, Colombia, Brazil, as you'll be very familiar with, to South Africa, Malaysia, Indonesia, all cutting interest rates last year. And that's really a function of the improved credibility, if you like, of monetary policy and inflation targeting in many of these economies. And just to demonstrate that structural improvement that has taken place, we just show here a subset of the major emerging markets. Typically, these are large issuers of local currency debt, and therefore form a large part of that local currency index. And over time, over the past couple of decades, you can see there has been a meaningful decline in the rate of inflation. And that's evidencing improving policymaking, improving credibility of independent central banks and their policies. And it also speaks to that distinction that we need to draw between the two asset classes, between local currency and hard currency, because typically the issuers within the local currency space are going to exhibit those stronger fundamentals. They're going to be the economies with lower and more stable inflation, because they are the issuers who are able to issue in their domestic currency. So with that, I'm going to shift a little bit to look at the role EM debt can play within a broad portfolio, how those characteristics we've mentioned can diversify, can add value to a multi-asset portfolio. And we'll start here just by looking at a simple correlation matrix of returns. So a lot of numbers on the page. I'm just going to pick out a couple of key points that we really want to highlight here. So firstly, EM sovereign debt, both local and hard, is positively correlated to equities. That's not a surprise. But if you look on the left-hand side, that correlation is about 0.6. So it's meaningfully lower than something like US high yield. So there is some diversification benefit there, we would argue, vis-a-vis global equities. And then if you look at the US Treasury market, you can see that the correlation of returns between both EM sovereign debt sectors and US Treasuries is close to zero. So very little correlation, again, allowing for diversification benefits. And slightly greater diversification benefits here coming from local currency. So a slightly negative return correlation for the local currency index and slightly positive for the hard currency index. They're the two numbers in green. And then lastly, just want to highlight a slight benefit or advantage to the local currency versus hard currency would be the correlation between hard currency EM sovereign debt and corporate debt is extremely high, or typically has been very high, over 0.8 over the past 10 years or so. That correlation between local currency, EM debt, and global corporates still meaningfully positive, but a little bit lower. So putting all of that together, we do see diversification benefits to allocating to EM debt. Within that, slightly better diversification benefits, we would argue, within the local currency space as it relates in particular to corporate debt or to US Treasuries, for example. So then just one last point here to make again on differentiating and contrasting between hard and local currency. Probably not surprising that you see a higher default rate within the hard or foreign currency universe. And that's not a surprise intuitively, because we know that governments can issue their domestic currency and obviously can't issue a foreign currency. So there's a higher level of fundamental default risk within a foreign currency bond. So you can see on this table that for a given level of credit rating, so for the same credit rating, there has been historically a higher default rate on the foreign currency debt than there has been on the local currency debt. So ultimately, we need to be aware when investing in either or both of these asset classes of the different risk and return characteristics and the different and distinct benefits that each can bring to a broad multi-asset portfolio. So with that, I'm going to hand it over to my colleague Mark, who's going to talk a little bit about valuations within each of those subsectors.
Thank you very much, Cian. I would just like to start this section just to reiterate some of the points that he's made. The local currency and hard currency emerging market debt asset classes are very separate and different. But actually, on the whole, as we've seen, fundamentally, there have been a lot of improvements in the emerging market economies. So my job here today is to look at some of the valuations between local currency and hard currency emerging market debt markets. And actually, there's a big fundamental difference between local currencies. Clearly, we need to deal with the valuation of the currency, and we do that separately. So actually, on the page here, we are looking at the 10-year real yields of the local currency bond markets. In the light blue boxes, we show the emerging market real yields, the 10-year real yields. And in the dark blue boxes, we show some of the developed market real yields. So what is a real yield? Actually, we're just taking the nominal bond yield for each of the local markets at the 10-year point. And Colchester, we forecast inflation to get a prospective real yield. And that's really our starting point when we come to value local currency debt. So you can see there is a big range between high real yields and low real yields. And actually, when we look at the dark and the light blue boxes, many of the markets which are on the right-hand side, the negative real yields are currently in developed markets. On the other hand, there are a few positive yields within the developed markets, but principally there is quite an attractive real yield, higher real yields in many of the local currency emerging markets that we look at. On the next page, we'll just have a look at the way some currencies are being valued. Here at Colchester, we look at the valuation of currencies in real terms. In other words, we look at purchasing power parity valuations. And where we see the zero line, essentially we find any currency to be at fair value. So we're having a look in at the developed market universe as a starting point, just to see where the US dollar is priced relative to developed markets. Here we're having a quick look at the euro, the yen, the British pound, the Canadian dollar, and the Norwegian krone. We have an equally weighted basket. And principally, we can see that the US dollar is somewhat overvalued, given that these developed market currencies are cheap. So as a starting point, when we're looking at the world and trying to find out whether currencies are cheap, the first thing that you would say is the US dollar, as a starting point, is somewhat overvalued on a relative basis. So that brings me to looking at the emerging markets and emerging market currencies out of the US dollar. Clearly, we can look at the values out of any currency, but just sticking with the US dollar at the moment, if we go right back to the 1980s and look at the weight that's in the local currency emerging market universe, we can look at the values relative to the US dollar. So clearly, it's a similar picture in emerging markets. Emerging markets on average are cheap. Their currencies are cheap compared to the US dollar, and actually quite substantially cheap. These dotted lines on the page are standard deviation marks. And the currency, at least last year in the coronavirus crisis, was further than 1 standard deviation cheap, but remains at that level, around the 1% standard deviation cheap here today. But we can develop this conversation further and look at some of the valuations of the individual currencies and perhaps compare that again to the developed market valuation. So again, in the dark blue boxes, we have the valuations of some currencies in the developed world. And again, in the light blue boxes, we have the valuations of those currencies in the emerging world. And I think the picture here is very clear. Those currencies which are below the line, less than 0, with a negative value, that is attractive, they're undervalued. And actually the picture across the world is that there are many developed market currencies that are cheap. We could buy those, choose to buy those, go overweight those currencies. And similarly, those currencies in emerging markets are on the whole undervalued, therefore being cheap out of the US dollar. And you could say that again, if you pick up the CLP, the Chilean peso, it's pretty much the same picture. So for example, all of these currencies are extremely cheap from the point of view of a Chilean or perhaps a Peruvian perspective. And then maybe moving on, we can take those undervaluation of these currencies and look at this in a different way and maybe compare them to the fundamental positions of these emerging markets. So we actually have a picture of current valuations, which again are in the blue box, and we also have the valuations as they were in the gray dots above the 0 line, most of them. And really, just before we start explaining what's on the opposite axis, you can see that the valuations, just as we saw on the other page, most of these currencies today are very cheap, below the line, below 0. And then looking back to 2013, many of the emerging market currencies that we're looking at, most of them there were overvalued, so maybe less attractive compared to where we see them today. But we can also look at the opposite axis. So we're looking at the current account plus FDI. So that needs a little bit of explanation. So when a current account is negative, that does need financing from somewhere. Typically, that could be with portfolio flows. That's very short term, but actually longer term flows like foreign direct investment. So that's longer term sticky investment, people investing in things like factories and long-term investments. So if we add that back to the current account, you can quickly find where those emerging markets have positive current accounts adjusted for foreign direct investment. So the right hand bottom quadrant is really the best place to be for investing. So this is where currencies are cheap and also have a strong fundamental position in terms of their current account position. Quite the opposite position as we saw in 2013 when currencies were expensive, and from a fundamental position, current account positions were relatively weak. So it's a really a strong story on both aspects. So perhaps moving away from local currencies, we can start to look at hard currencies and hard currency valuations. Here we can just have a very simple chart. We can take the hard currency index, which is the JP Morgan emerging market bond index, which is globally diversified. And we can take the average yield spread. So let me just explain what a yield spread is. A yield spread is the premium that is above US Treasuries. So in other words, the amount of yield that you would need to compensate for taking on extra risk. So obviously this blue line does move around. It goes, if we look back to the credit crisis there in between 2007 and 2009, clearly spreads widened due to the heightened levels of perceived risk. And again, you can see that blue line, the spreads widening again in the coronavirus crisis last year. The grey line is a point of interest. This is a way of looking at the universe on a like-for-like basis in terms of its credit quality. So what the grey line is the BB rated spread. That's the average BB rated spread. And we take a 5-year moving average of that spread, and we can compare the overall index which is BB rated to that. So putting it quite simply, when the index is above that line, you could see that as potentially being cheap, and below the line as expensive. So the story is fairly clear. With the crisis that started last year, clearly the hard currency emerging markets were cheap, and you can see that it has moved some way back to its fair value, which is dictated by this ratings adjusted spread. We can develop this story a little further though, and drill down to see where this cheapness is coming from in terms of the hard currency spreads. So what we do in the next two charts, this first chart is the investment grade spread. That is those countries with higher than BBB minus rated emerging market hard currencies. And on the next page, we'll look at those countries with that are non-investment grade. And here the story is quite simple. If we just simply look at the spread from the investment grade universe compared to its long-term average, clearly those spreads that we saw and the spread widening from last year has clearly gone back to where we were, the levels, the spreads of around about 150 before the coronavirus crisis. So one might state something quite simple, that perhaps the investment grade portion of that universe is at least back to fair value, if not expensive. But then when we compare that to page 24, you can see the story is quite different. So again, those lower rated names within the universe having a higher spread, a higher average spread, if you like, and that would be normal. You would want to be compensated for a higher, with a higher spread with a lower credit rating. But you can see in the most part, that spread has not gone back yet to its long-term average. So in other words, to extract or potentially take a view on hard currency and the cheapness that we see in the hard currency universe, you have to be aware that where the values are attractive are in those lower rated names within the hard currency universe. So perhaps we can look back again, and this is a chart that Cian showed us earlier. This is not a mistake. We intentionally put this back into the presentation, just to reiterate the point that the difference between hard currency and local currency credit ratings across the various buckets, the hard currency universe is typically a lower rated. You can see that there are much of the exposure is in that lower rated single B, triple C type of credit ratings. But actually, principally, that's where the better valuation is on hard currency. So if you were to compare the asset classes, local currency emerging markets is still very attractive, higher levels of real yield and cheaper currencies. Whereas hard currencies, really the better quality names, those investment grade names have already moved, and they're at least long-term average, or if not below that long-term average in terms of the valuations. So a very different outcome when you look at the credit ratings. So at this point, I think I'll hand back to Cian, who will summarize the overall presentation before we open up for questions.
Thank you, Mark. Yes, so really at this stage, we just want to draw a couple of conclusions from what's been said and open it up to your questions. So we've seen that, in our opinion, the local currency and hard currency EM sovereign debt asset classes, if you like, need to be considered as distinct with their individual risk return characteristics. The local currency universe is larger, it's growing more rapidly, and offers a higher average credit rating. And even though the hard currency universe has historically offered higher returns, we believe at this point that the valuation of EM currencies is relatively attractive. So as Mark has said, we're in an environment today of an overvalued dollar. That was particularly the case if you go back to probably this point 12 months ago. So the end of the first quarter of 2020, the US dollar was extremely overvalued. Since then, you've had some weakness come through, but fundamentally, we still believe, and those charts earlier demonstrated that, we still believe the US dollar today to be relatively expensive. That means there is the potential there for these EM currencies to strengthen, to benefit from a weakening of the dollar and to contribute to the overall return on local currency. So that's ultimately the conclusion and the outlook from here, but we would be more than happy to answer any questions people might have. So I might just hand it back to the host for now. Thank you.
Analia, do you want to take the questions or do you want me to take them?
Do you want to start with the questions from the chat, Barbara? Because we have a couple there. I have them in front of me. Otherwise, I will start with the questions from the chat.
Perfect.
So the first one, so could you please confirm which BRL dot is correct on page 21? That's the first question. So it's referring to the Brazilian real dot on page 21.
So, Cian, you have the mouse. Perhaps you'd be able to.
Hopefully it's on screen now, this chart.
That's right.
So the two dots for Brazilian real, the gray refers to 2013. The blue refers to the latest or end of February 2021. In other words, as of today, the Brazilian real, in our opinion, is meaningfully undervalued. So that roughly minus 28% means undervalued relative to the dollar. And it has a positive current account balance adjusted for net FDI. So it has shifted from the top left quadrant in 2013 to the lower right quadrant today. Hopefully that makes sense, but we just want to demonstrate that over that time period, so Brazil is a good example, the Brazilian economy has reduced its external vulnerability, and at the same time, the currency today is much more undervalued than it was. And 2013 is relevant, of course, because that was really the start of the so-called taper tantrum. And we are in an environment today of rising yields in the US, and some analysts suggesting that we might see some kind of repeat of the taper tantrum. So the point here that we want to make really is that the fundamentals are very different.
Well, thank you. I have the second question coming through. So it says you compare the double B spread and the MBIG spread, arguing the MBIG is double B rated in average. Has this always been the case? Has the average rating moved or improved or deteriorated throughout the years?
Excellent. Thank you, Annalie. That's an excellent question, actually. Cian, would you mind, could we go on to page 22? So we can just have a look at that rated adjusted spread. So that is an excellent question. So I'll just repeat the question in a way. So the average credit rating of the MB, the index, is double B currently. So essentially what we're having on the gray line is to have a rated adjusted spread. And clearly there has been an improvement in the average credit rating. We've had many new entrants, mainly from the Middle East, which has improved the credit rating of the overall index. So therefore we have to adjust for that through time. So when we're looking at this gray line moving through time, it does reflect the changes in the average credit rating of the index through time to make sure that we're comparing apples to apples at any one point in time. So that was a great question. Thank you very much.
Right. Then I have another question. Have you further assessed how the EM hard currency sovereign and corporate slices have performed relative to each other?
I can make a couple of comments on that one, and maybe Mark would want to come in as well. The short answer is that we haven't looked very closely at EM corporates, given that as a firm, we only invest in and focus on sovereigns. I think what is important to remember with EM corporates is that many of them are global companies with global activities, and so typically have relatively strong ratings actually compared to the sovereigns within the universe. So the EM corporate universe is probably somewhere closer to investment grade global corporates than it is to the sovereign universe that we're looking at. Similar in many ways, because the companies, even though they're established, if you like, within emerging markets, they often tend to be global companies. So there's probably, I don't have the exact figures in front of me, but there's probably less spread on offer within the EM corporate universe than there is within the sovereign universe. But maybe Mark might have something else to add to that.
Yeah, thank you, Cian. The only thing I would add to that is the spreads of corporates are actually reasonably tight right now at 300 basis points over US Treasuries. The ratings of emerging market corporates are reasonably strong. It's just that the duration within that asset class at around about 4.5 years is reasonably high enough to make a meaningful impact if spreads did widen. So actually just taking that together, it's not something that we look at particularly in great detail, given that we do not buy any corporates here at Colchester, like Cian just mentioned. It's just that spreads are very tight at the moment. So it's just something worth noting.
Good. We have further questions on the chat. Barbara, do you want to go on with them? Do you want to take it from here?
Perfect. Do you see a dollar weakening trend as being more beneficial to hard currency due to reduced interest payments, or local through currency effect?
It's probably a positive for emerging market assets in general, but in saying that, our view would be that it's likely to be more beneficial to the local currency universe. Because if you look back at historical returns, whilst hard currency has typically performed somewhat better, of course, in normal circumstances or through time, EM currencies have weakened in nominal terms. So if we're at a point in the cycle, as we believe we are, where the dollar is likely to weaken over the medium term and EM currencies appreciate, that would suggest that you're likely to see a stronger contribution to EM local currency returns going forward than you have had historically. And that performance might swap around with local currency outperforming hard.
Thank you. So next question, what are your inflation expectations? Do you consider an acceleration of the inflation as a possible threat?
Maybe I could start with this and ask Cian to come in with some further thoughts. So inflation is possibly one of the most important things that we're looking at here at Colchester. It's the thing that we use. Inflation forecasting is used to derive the real yield. So possibly we have a few insights on that. It's possible, given that people know that we are inflation forecasters, we do get this question quite a lot. And actually, it's quite true at the moment that there is a lot of concern about inflation, just given the amount of policy easing that has been made, not only in the developed market worlds, but actually that's true of the emerging markets as well. So with that, there's two types of major policy changes that we've seen. Is first of all, clearly central banks have reduced rates in defense of growth, and not only that, of course, there's a higher amount of spending in defense of the coronavirus crisis. And also, possibly on top of that, a lot of people have been saving. Those people who've been fortunate enough to keep their jobs have managed to save. So actually within most countries, we're seeing a large increase in the amount of personal savings. So I think that is the dilemma. We're seeing money supply growth increase and increase dramatically. So if you start off with the US, that's at a rate of around 25% year-on-year growth. But actually, when even looking at the emerging markets, you are seeing extremely high levels of money supply growth. So that might lead one to believe that inflation is around the corner. And I think we do have some sympathy with that view. But just going back to the point that we made in terms of the savings rates that we're seeing around the world, they're still at very, very high levels. Although the coronavirus vaccines are being rolled out around the world, it means at the moment that people aren't spending in the same way. So certainly we have some concerns, if you like, in terms of the evolution of how that money will be spent. So indeed, we do believe that inflation is it could be around the corner. It's just a question of the timing of that. So although when we compare ourselves to the market in terms of the individual inflation forecasts, we might be slightly lower. We might have slightly lower inflation forecasts due to that concern on the consumption trends at the moment and the savings rates. But we do recognize there is a risk for higher inflation. Just again, the question mark is when, and we're just waiting to see some evidence for that. So perhaps maybe Cian would add to that, given that we do a lot of work on inflation forecasting. Cian, I'll certainly have a view.
Maybe just, thanks, Mark. Maybe briefly, in the interest of time, I think we also need to look at the near term and medium term time horizon. In the near term, there will be some upward pressure on inflation as we see a reopening of economies, an increase in spending, and the base effect from the drop in the oil price 12 months ago. So there's a natural tendency for inflation to increase in the next few months. But that doesn't necessarily mean it's going to continue into a sustainable or a self-sustaining increase in inflation. I think what many central banks are expecting is that after the spike in the next few months, that inflation will then normalize to probably still a relatively low level. And I think there are structural reasons why there will be some dampening impact on inflation. The things that we talked about before the coronavirus came along, demographics, automation, technological innovation, all of these things are still there and can still exert some dampening impulse to inflation, I think.
Thank you. There's one more question in the general chat, and we have a lot of questions that have been sent to Analia and me. Analia, I do the last question on the chat, and maybe in the interest of time, you can choose 2 or 3 so we finish on time. What are your views on investing in Chinese bonds?
Actually, that is quite a very big subject. We could easily make a presentation in an hour, given our last meeting with the CFA was exactly that. But in brief, the case for China and having China within these benchmarks is extremely strong. The correlations coming from China is very low, and it does help diversify the universe. Maybe if we go have a quick look at the valuation on page 17, I'll try to go quite quick. The valuation on offer in China is in the middle of the pack. at 1.2% real yield on the bonds. Now, one might think that is attractive, and it certainly is in a global context. But here at Colchester, we do make further adjustments to these valuations according to financial strengths and weaknesses. And part of that comes down to ESG. And this is something that I touched on at the last meeting. So unfortunately, China do have a few difficulties, particularly on the financial side. They have debt to GDP of around 260% of debt to GDP. On the government balance sheet, that's actually considerably lower. It's only 60% on the government balance sheet. It's just that we do think there could be some contingent liabilities coming from the corporate side. When we look into governance of that component of ESG, again, we do have some considerations which leads us to a very heavy penalty against that valuation. So although China as a raw valuation in terms of the real yield is very attractive now at 1.2%, the adjustment that we make to that valuation is quite negative, which reduces the attractiveness. So we do hold China within Colchester portfolios. It's just that we are underweight in terms of the bonds in the portfolios.
Thank you. Analia, you take over?
Yeah. So I have a question here. The yields are rising in the US. What does this mean for EM in general?
Happy to take that one first, and maybe Mark can come in if he's anything to add. I think it depends on what's driving yields higher in the US. So to the extent that higher yields are driven by an upgrade of expectations for economic activity, that's positive for emerging market assets. To the extent that inflation is increasing modestly, driven by that improving economic outlook, again, I think that's generally a positive for emerging market assets. We clearly saw in 2013, in that taper tantrum period, that a sharp, sudden increase in US yields can have negative implications for emerging markets as capital flows potentially reverse and capital shifts back into the US to take advantage of those higher yields. But again, as that chart showed, emerging markets are, at least many of the emerging markets today, are less reliant on portfolio inflows to start with. So we believe that the vulnerability to a sudden stop in capital flows, or the vulnerability to US interest rates sucking capital back to the US, is lower than it was then. So I think the answer really is a nuanced one, but as long as the increase in yields in the US is driven by an improving economic outlook and doesn't happen too quickly or too suddenly, then I think the implications can be positive for emerging markets, albeit it also depends on the balance sheets. There are certainly some individual markets, particularly in that hard currency index, where there's a large stock of foreign currency or dollar denominated debt, and higher funding costs are going to be difficult to absorb. So there are idiosyncratic issues, but I think in general terms, higher yields in the US could conceivably be a positive.
Okay, and the final question, just to wrap it up, it pertains more to asset allocation. And the question here is, how long should investors aim to hold exposure to the asset class? And I think with that, Cian, we can wrap it up. And obviously, if you have more questions, which we have received, we're happy to answer those with the email that we put, which is our marketing and finance services email.
I think
Go ahead, Mark.
Just to answer the question directly, there does seem to be a life cycle of valuations when we're looking at things like real yields or the valuations in currencies, which does range between 3 and 5 years, perhaps a little longer in individual currencies and bond markets. So we would probably recommend to clients that if you are to allocate to emerging market government bonds, whether that's hard currency or local currency, to certainly think about doing that in the medium term. So again, like maybe a time horizon of 3 to 5 years alongside that cycle.
Okay. I don't know if you have some closing words, Mark and Cian. Otherwise, I will say thank you very much for your time, for this great presentation. And thanks, Analia, for the support, for setting it up. And thank you for everybody for participating. We had more than 100 participants in the call, which is really, really very good attendance. Thank you.
Thank you. Just to add, Barbara, that we will be sending out the presentation. So if anyone wants a presentation, they can request it directly to you guys in the CFA Society, or they can email us. So we're happy to share that with everyone. Muchas gracias. And thank you for lunchtime again.
Gracias.
Gracias a todos. Boa tarde.